Let's forget about your net worth, FIRE number, and how much you have invested so far, because there are several accounts you need to close before you're considered financially independent or before you decide to retire early. The first account you need to close is your credit cards. But wait a minute, this is for the people who have a spending problem with their credit cards and carry a credit card balance month over month. If you have a history of a spending problem or not paying off your credit card balance in full before the end of the month, then you should stick to just using your debit card or cash. And every time you hear about credit cards, you either learn about two things. You either take advantage of the rewards program that it offers, or you get into deeper credit card debt. And trust me, I've been there. Back in 2013, I had $47,000 in credit card debt. And I once believed that all those rewards I got were worth it until I realized I had over $47,000 in credit card debt. Do I use credit cards today? Absolutely. When I completely paid off my credit card debt in 2016, I didn't use my credit cards again for a year until I had my budget figured out. And once I had my budget figured out, I started using my credit cards again, but not because I had $15,000 on my credit card limit, but because I had $200 that I could spend on it with a 3% cash reward. Now, I'm not saying that you should use credit cards to build your wealth. No one in the FIRE community would ever say that they're becoming millionaires with credit cards. It's more of a lifestyle hack that I use to be able to stay at a Marriott for 3 nights for completely free, because all the points that I accumulated from the work trips that I took throughout the year. And some of you choose not to use credit cards because the rewards you get from the bank are basically from the interest that people pay the bank who can't pay their credit cards off every single month. And I completely get how predatory that is, and it's against your moral belief, and I completely respect that. With the average interest rate for credit cards at 24% and the Federal Reserve consistently raising interest rates, these credit card debts will stop you from achieving financial independence and retiring early. If I can pay off $47,000 in credit card debt in 2 years, you can definitely do it too. And I have several spreadsheets and other resources that you can use to help you pay off your credit cards sooner by visiting firesuccess.com/contact. While you're on the website, you should also check out my Fire Success shop to check out the books and equipment I use at firesuccess.com/shopping. The second account you need to close is your student loans. And I know this may sound like common sense for many of you on the FIRE journey, but there are people who plan to have student loans until they're 60 or 65 years old. The common argument I hear is that if your student loan interest rate is only 4%, why should you pay it off sooner, right? But let me ask you this. Do you really want to hold on to your student loan that you can't even use as a tax deduction for the next 20 or 25 years? Let's forget about the interest rate and look at it from a bigger picture. You use the student loan to pay for your degrees. You need to use that loan to get some kind of return on investment, right? And if you borrow $50,000 to get your bachelor's degree and you now make $75,000 a year because of your degree, could you spend the next 2 years paying off your student loans? Let me put it differently. Would you make the sacrifice of using 30% of your income to pay off your student loans in 2 years so you can start investing to retire early? And you can't consider your student loan the same as your mortgage. And I'm making minimum payments on my mortgage payment because I know that my house will continue to appreciate, and I'm investing the difference to make my money grow in my investment accounts. The student loan, on the other hand, does not appreciate in value. You use your student loan to invest in yourself with an education, right? The average student loan payment in America is about $400 a month. And what if you could invest that $400 a month into the taxable brokerage account and let it grow 8 to 10% annually? No matter how you look at it, and even if it's considered a low interest rate, carrying a student loan beyond 3 years after you received your degree is considered a liability. It is a bad debt because you're holding on to something that doesn't appreciate in value over time while you're paying interest on the payments. By the way, I just launched a new live stream program on my channel, which include live Q&As and group coaching sessions about the FIRE movement, stock market, real estate, and any current events in the world. With the private membership program, you'll have access to my private Facebook group and group coaching sessions to discuss your financial independence journey. You can check out my YouTube channel for more information about the private membership program. You can also schedule a free one-on-one 20-minute financial coaching session by visiting firesuccess.com/coaching to discuss your personal finances. The third account you need to close before your early retirement is your car loans. Look, I get the fact that you want to buy a car that is new, reliable, and safe for you and your family, but you really have to ask yourself if you can actually afford it. The average car payment in the US is now about $700 a month, which is absolutely insane for something that's depreciating in value every single day. Have you ever wondered why cars become so upside down in value against what you actually owe on the loan? You bought a car in 2019 for $25,000 and your car is now worth $10,000 in 2023, but you still have $15,000 on your loan. And this happens to Americans every single day. It happened to me several times and it just never clicked for me. And I just continue to carry over the losses to the next car loan when I traded in for a new vehicle. And I made car payments for 12 years straight because I traded in my vehicle every 3 to 5 years, with my car being upside down in value every single time. And when I used to shop for a new vehicle, I looked at the monthly payment instead of the overall loan amount, depreciation value, and interest rate. This is why a great majority of Americans are driving cars that they can't actually afford. When you buy a vehicle with a 5% interest rate, you're not just paying 5% interest on your car payments, but you're also paying 10 to 15% in depreciation annually. And it's going to hurt your net worth in the long term. And my car buying guide is to make sure I buy a vehicle that I can pay off within 12 months. So if I buy a car for $25,000, I should be able to pay off $25,000 in 12 months. If I can't, then I simply can't afford it. It's perfectly okay to buy a used car that's about 2 or 3 years old to save money on the initial depreciation and value. So if I had to buy another car today, I would use cash to pay for it. Would I ever get a loan? Absolutely not. Regardless of the interest rates on your car loan, pay it off as soon as you can because your car will depreciate so much more in value. If you're gonna buy a car, make sure it's a car that you're gonna hold on to for 10 years or more. Because think about it this way. If you invest $700 a month instead of making a $700 car payment, with a 7% return, you would have over $122,000 invested in 10 years. And let's just do $300 a month instead. You would still have $52,000 invested in 10 years. And if you're looking to switch vehicles every 10 years, that is actually not a bad strategy to just invest $300 a month in a separate account. In 10 years, I hope to buy a newer model of Tesla with just cash from my non-retirement investment account. I would rather pay 15% in capital gains tax than pay 5% in interest every single year. Stop asking how much your monthly payment is gonna be. Instead, start asking how much you're willing to pay for a replacement vehicle in 10 years. Any car loan is considered bad debt because it is depreciating in value. And if you wanna know more about how I paid off $47,000 in credit card debt and decide if you should invest or pay down your mortgage, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe and I hope to see you in the next video. Have a good one.